Hi, it's Tim Quast. Good to see you. I'm talking about the easy steps for using Edge, and there are 5. Number 1, understand the dashboard. That's your command central to see what all the money in the market's doing. Create portfolios. Number 2. 3, learn entries and exits. That takes some practice, takes some time, and you just have to try it. That's the best way to learn. 4, which we're going to talk about today, is back testing your data. We want the best probabilities we can achieve. And how do we get to those? Well, we want overall market sentiment to be on our side. That's easy step number 5. We want to go look at the dashboard and figure out where the money is strongest and concentrate in that area, and then go the next level down and pick the best stocks out of that area. And that's how we get to the highest probabilities of good returns, taking gains, not chances. So let's go learn easy step number 4, which is back test your data. And that's going to be Profiler. See this thing up here called Profiler on your navigation pane? That is the back testing engine. And by the way, you can do this from any place. So let's say we're here in this gamers portfolio. If I want to just go look at Activision, I can click that ticker, and that will take me right over to the Profiler. You can do it from just about any place using the action buttons. So here you'll see actions. We're already in the Profiler, but you can, in a different view, in the portfolio view, it will say, do you want to profile this? And you can click it from there. Very easy to navigate around and do those things. So the default will be a 90-day period. It's just a good way to think about it. Every quarter things change. Risk in the markets may change, and hedge funds will respond to that. Asset allocation models that your own financial advisors or managed accounts will use. I have those too. We may make adjustments there. Indexes rebalance. Money reallocates. Are we going to shift from equities to over here? That stuff happens every quarter, maybe even more frequently. But that's why we look at that period of time. If you go back 15 years, you're not getting an apples to apples comparison. The market had different rules, much different behavior. But this is what we're going to do. 90 days, and we want to use what we call the 5-5 rule, that the returns and most stocks, the highest probability is when stocks rise above 5. Now you have more demand than supply because it's above 5 on a 10-point scale, that the gains tend to be there. So if we bought it as it rises above 5 and we hold it till it drops back below 5, high probability. It's not always right, but that's a good starting point. So then this will give us the data, and it tells us, well, that's not very good, right? If you bought and held it, you lost 21%. That's not what we're looking for. If you traded it using 5-5, you still lost money, but only 4%. Already better, but we don't want to lose money, so that doesn't make sense. So then we want to understand why. By the way, here's the data. 90 trading days. We only traded for 17 days using this data. And there are 3 periods comprising those 17 days where we would buy and sell using the historical data, which means the average holding period would be 5 days. That's kind of me. I own stuff 3, 4, 5 days in most cases. Sometimes it's longer. But we can look here and say, well, why is it not doing well? Because it's not been at 10. I mean, if a stock doesn't get to 10 and it's only spending 20 days out of 90 above 5, that's not very good. So what would we do? Well, we might say, well, the best thing could be to buy it when it's a 1, and we could test that and see. And sure enough, now we've produced a return. It's not great. And maybe we sell it at 10, but it never gets there. So that we know that's not going to work. Maybe sell the down tick. We just want to check the data. It keeps coming back to 4. But that's what you do. You want to increase the probability of producing a return. And that's giving you the historical view. But now you know what to do. You know that there's a higher probability of producing a return if you buy Activision, ATVI, at 1. Then you don't just go buy it. Those conditions have to be right. And if those conditions aren't there, then don't do it. And the second piece that I like to look at is the return. So there are 3 trading periods, and it'll tell you how long. So 10 days, 14 days, 6 days. And each of these trading periods historically produced a return. So this trade has a very high probability of producing a return. That's what it's telling us. And if you hit that little arrow arrow there, you can see each day through the process, and it'll tell you the total return and what happened each day. So right there, that's what I would do. So I bought it at 1, and the very next day, so I bought it on a Friday, on the next Monday it's up, it's up 3.4%. I'm out. I like a 3% gain in a day. It's given me an entry, a high probability entry, and now I can wait. I can choose to wait to follow the data for when to leave, or I could take my gains, not chances. But isn't that awesome? Right there, here's a stock that has done nothing but go down, and yet we just made 3%. We could make 3% on it there. That's learning how to backtest your data and give yourself the best probability of good returns, profitable, lower risk returns. We'll do easy step number 5 next.